Okay, let's unpack this.
Ready for the deep dive.
So, the source material you've shared gives us a really fascinating look at a company trying to, well, achieve the ultimate corporate makeover. We are diving into OnMobile Global, a name that for a lot of us is kind of cemented back in 2005. This is the company that built its fortune on legacy mobile entertainment. I mean, we're talking ringback tunes.
Oh, yeah, the digital furniture of that whole era. They were king of that ecosystem.
Right, but that's the massive nostalgic legacy they now have to fight.
It is, and you're right, that history is now the anchor they are trying to cut. The core theme from all the analysis is this clear, really dramatic pivot over the last, say, 12 to 18 months.
And this isn't just a marketing shift, right?
No, not at all. It's a structural transformation. They're moving toward high-growth, high-engagement gaming platforms, and there's some heavy AI integration in there, too.
Exactly. So our mission today is to cut through that management narrative, the high-octane turnaround story.
And pressure test it.
And pressure test it against the cold, hard financial and technical reality. Where are the actual proof points for this pivot? And I guess, what are the execution risks that could derail all this explosive growth?
I think the initial takeaway is critical here, and it really frames this whole deep dive. The overall structural outlook is positive if, and it's a big if.
If they can keep it up.
If they can maintain this new execution momentum and cost discipline. But we have to constantly remind ourselves of the volatility, the thin margins, and the significant scaling costs that really haunt their history. This story is not without some serious downside risk if they stumble.
Okay, let's jump right in then. The strategic pivot itself, trading ringtones for gaming targets. Management is now framing the company as a global mobile gaming and entertainment entity.
And that new framing is everything. It defines their ambition. They've set a stated and, frankly, incredibly aggressive target.
Which is?
Gaming is intended to contribute about 50% of total revenues in the next 18 months.
50% in a year and a half. That requires a complete internal overhaul and, successful external scaling against giants like Tencent and a ton of local players.
Absolutely. And the evidence for that scaling is in the new product stack. This isn't just, slapping a new label on old services. They've built an entirely new gaming infrastructure.
So what stands out in the sources about these new platforms?
Well, you have several dedicated platforms. There's Challenges Arena and Ono. Both are focused on competitive and social gaming where users compete for prizes.
Okay.
And then there's the foundational gaming platform product itself, which kind of underpins everything and helps them distribute through telecom channels all over the world.
The piece that really struck me, though, the aha moment that shows they understand emerging markets, is the newly launched virtual console.
Yes. Calling it a game changer in the sources isn't hyperbole, assuming they can execute.
Right, because think about the market. It's an attempt to bring a high-quality, almost console-like gaming experience to emerging markets without requiring the user to go out and buy expensive hardware.
Exactly. The tech streams high-fidelity content, effectively.
So if you're a user in, say, Africa or Southeast Asia, you don't need a PlayStation or an Xbox. You just need a decent mobile connection and their app.
It's an infrastructure play. It's designed to tap into billions of mobile users who have the appetite but just cannot afford traditional consoles.
It dramatically expands their addressable market, but it also means those infrastructure costs have to be kept really tight.
Precisely. And that brings us to the second crucial lever that's highlighted again and again in the sources, AI.
Right. And it's not just a buzzword here.
No, it's actively integrated into their core monetization loop. For example, AI algorithms optimize content recommendations to keep users playing longer. But crucially, they also manage dynamic pricing and cross-selling offers.
So how is that AI actually helping them move from, selling ringtones to profitably streaming games?
Management's view is clear. AI-driven optimization is the key lever for improving average revenue per user ARPU. And most importantly, for improving those historically thin margins. If they can make monetization smarter and more efficient with AI, it directly helps validate the entire turnaround story. So that's the strategy, the ambition. Now we have to stress test it with the actual numbers. Let's look at the financial traction because there's a real dichotomy here.
You mean the explosive growth in gaming versus the company's history of, inconsistent profit?
Exactly. And the momentum in the new division is genuinely staggering.
I mean, to put a number on it, for fiscal year 2025, active gaming subscribers jumped an incredible 58% year over year. They hit 10.65 million. That is serious scale building.
And that subscriber increase translated directly to the top line. Gaming revenue growth in FY25 was about 158% year over year.
Wow.
Those are triple-digit growth metrics. You just don't see that in mature tech businesses. It proves the shift isn't theoretical. It's generating real, actual revenue.
And we saw that acceleration translate into much better sequential performance, too. Q3 FY25, I think gaming revenue nearly doubled quarter over quarter.
It did, to about 754 million rupees, which drove a sharp sequential improvement in their core operational profit metric, their EBITDA.
Right. EBITDA earnings before interest, tax, depreciation, and amortization, that's what we look at for operational health.
And it jumped sharply to 81 million rupees in Q3. That momentum then continued into Q1 of FY26, where the swing to profit was really confirmed. Revenue grew 17.1% sequentially, and profit after tax swung decisively into positive territory.
Hitting about 156 million rupees. And that was attributed to operating leverage and tighter cost control, which validates what management has been saying. But wait, let's look at the bigger picture. If gaming revenue grew 158% in FY25, why did their overall operating profit for the full year fall so significantly? It dropped from over 420 million rupees to about 160 million.
That is an essential point. It's about the cost of scaling. Total expenditure rose sharply in FY25, hitting about 5.62 billion rupees.
So it's the investment.
It's the huge, unavoidable costs of that investment, the infrastructure build-out, and the marketing to acquire those 10 million new gamers. The challenge is that initial scaling is expensive. It eats up the gross profit from the new revenue.
So the operating leverage won't kick in until acquisition costs level off and they actually retain the subscribers they've bought.
Exactly. Now, we do have the latest data from Q2 FY26, the half-year results. Revenue from operations for that quarter was nearly 1.3 billion rupees, and profit was a strong 59.45 million.
Okay, that's good.
But here is where the turnaround story gets really compelling, and it's on the balance sheet. Cash. Their cash and cash equivalents nearly tripled in just 6 months.
Tripled.
Yeah, from about 300 million rupees at the end of March 2025 to almost 800 million by the end of September.
That is a fundamental change in the company's financial metabolism.
It is. Net cash generated from operating activities in that half year was over 570 million rupees, a massive reversal from the cash burn we saw the previous year. The business is finally starting to throw off cash.
Okay, but now for the necessary historical caveat. We can't get carried away by the recent wins without acknowledging the history. You mentioned volatility.
We have to. Historically, the data shows a really weak 5-year sales KGR. That's compound annual growth rate, and low or often negative average RA, return on equity.
So, in simple terms, they were destroying shareholder value for a while.
For a long while. The turnaround is still early. It needs several more consistent, profitable quarters to be truly validated against all that historical baggage.
Let's move to the global footprint and future targets then, because this pivot really needs a worldwide stage to succeed. This isn't just an India story.
No, it's highly diversified, which adds a layer of stability. Looking at the Q2 FY26 revenue breakdown, Europe is still the largest generator at over 559 million rupees.
And after that?
Followed by Africa at about 237 million, and then India is the third largest, bringing in close to 200 million. That diversification protects them from single market shocks.
So while gaming is clearly the future, that legacy mobile entertainment business still acts as a critical floor for them.
It does. The sources suggest this legacy business is expected to stabilize and even grow modestly, about 5% year over year by FY26. And that stabilization is crucial. It acts as a reliable cash-generating base while the expensive gaming tower is being built.
Okay, so if we connect that to the bigger picture, the forward-looking targets they're pretty aggressive.
They are. They reflect management's conviction in the new strategy. Gaming revenue growth is projected at roughly 50% in the current fiscal year, FY26.
A 50% target. And they've put hard numbers on the scale, right? They're targeting around $2 million in monthly recurring gaming revenue by March 2026. That gives you, the listener, a very specific metric to track.
And subscriber-based expansion is targeting 13.7 million gamers by Q2 FY26. The key upside drivers are that continued high double-digit gaming growth, successfully scaling the gaming platform and virtual console, AI-led ARPU expansion, and, critically, continued improvement in operating cash flows. The analysis points out their gross cash is now already over 1 billion rupees.
That's a necessary buffer for continued investment.
Now, here's where it gets really interesting for me, the technical analysis. We move from the spreadsheets and the fundamentals to the stock chart, which is basically the market's emotional response to this whole turnaround story.
And the chart seems to confirm that this company has been through a rough patch. Investors are still skeptical, aren't they?
Very. The weekly chart shows a lengthy corrective phase. It moved from a primary downtrend into a wide sideways range. It's currently just oscillating in a trading bracket between roughly 50 and 80 rupees.
So it's base building, grinding sideways.
Exactly, a multi-quarter base building process.
So where's the structural risk visible on that chart right now?
Well, there's a major support band in the mid-50s. Price has tested this demand zone multiple times since 2023, and while it's proven strong, the risk of a breakdown is always there if the fundamentals waver.
And on the upside?
On the upside, you have the 200-week moving average. That line is crucial. It acts as strong dynamic resistance, and it visually separates that prior long-term bullish phase from this current corrective phase.
So the chart is basically saying, I believe the worst is over, I'm not making new lows, but I haven't actually bought into the recovery story yet.
That's a perfect way to put it.
What about momentum indicators, like the RSI?
The Relative Strength Index, the RSI, is our momentum thermometer. It's currently neutral to slightly bearish, oscillating between 40 and 60, which is typical for a range-bound stock. However, there's a crucial positive sign.
Okay.
We're seeing what's called positive divergence.
All right, hold on. Let's quickly define that. What does positive divergence mean in practical terms?
It means that the recent RSI lows are not hitting new extremes, even as the stock price itself revisits that support level near the mid-50s.
So the price keeps falling toward the bottom of the range, but the intensity of the selling, it's just evaporating.
Exactly. The selling pressure is getting weaker. The chart is getting tired of falling, which suggests a base is forming. It's a great leading indicator.
So it suggests the selling pressure required to push it lower might be exhausted.
It might be. But here's the technical hurdle. The RSI has yet to hold above 60 for any sustained period, and that move is typically required to confirm a strong new bullish phase has begun.
So until that happens, rallies are suspect.
Exactly. Rallies that push up toward that 80 rupee level are likely to be capped by long-term sellers.
So what does this all mean for someone looking at the stock now?
For positional investors, you, the listener, looking for that long-term payoff from the gaming pivot, the stock needs to break the range. The high-conviction technical case requires the price to sustain a move above that 75 to 80 supply zone and challenge the 200-week moving average. That's the real test.
Okay, to wrap this up, let's synthesize that financial success, the stunning growth in gaming and cash with this technical caution. The execution in gaming has been fantastic, but the headwinds are fierce.
There are three major risks that stand out. Number one is pure execution risk. It is extremely difficult to turn gaming scale into durable high-margin earnings.
Especially with the intense competition out there.
And rapidly changing user preferences, maintaining 10+ million subscribers requires continuous innovation.
The second is external volatility, I'd imagine.
The gaming industry is global. That brings potential volatility from M&A, global tax issues, and regulatory changes, especially in how telecom partners are allowed to bill for these kinds of services.
And the third risk. This relates back to the recent rallies we've seen.
Yes. Guidance undershooting. The market is now pricing in aggressive growth. If the legacy entertainment stabilization or the gaming growth undershoots those aggressive targets, especially that 50% revenue growth, that positive sentiment will reverse, and it will reverse fast.
Right. And we should also note the operational risk from their distribution dependence. They rely heavily on a concentrated set of about 120 global telecom partners.
Absolutely. If a single major partner, say in Europe or Africa, changes their billing terms or partnership, it could have an outsized negative effect on revenue.
So what does this all mean? You're navigating a true corporate pivot. It's showing genuine explosive growth in gaming, coupled with dramatically improving cash flow. But all of that progress is weighed down by a history of volatility, high scaling costs, and a stock chart that's still waiting for a real confirmation.
The analysis suggests that combining this news flow with a simple model that, sensitizes gaming revenue growth, EBITDA margin progression, and cash buildup over the next 8 to 12 quarters is essential to really validate the valuation. What should you specifically watch as that model runs?
I think the ultimate validation of this entire turnaround story hinges on sustained movement. It hinges on acceptance by that long-term investor base. Keep a very close eye on the technical chart. Can the price not only break, but actually sustain a close above that stubborn 75 to 80 resistance zone? Or will sellers just continue to cap the rallies? That technical breakthrough is what will signal whether the fundamental pivot has truly been priced in.